All right, everybody, welcome. Merrill Chandler here, your host of the Fundability Report, our industry intel on what's hot and what's not with lenders, banking, and fundability. So, first things first, let's talk about Arizona voters approved new limits on consumer debt collection, meaning that Proposition 209 was a referendum that and 72% of voters basically shut down the prying and invasive collection practices, even allowed by the Fair Debt Collection Practices Act. So now industry groups, of course, oppose the matter, collection agencies, et cetera. But this is a pretty serious pro-consumer movement in a very pro-business state. So we're going to be, I'm sure we're going to be hearing more about this, but it severely restricts the ability to collect debt, especially by third-party collection agencies. There's not as many constrictions on the lenders being able to collect, but giving it to third-party collection agencies is where there has been a big win. All right, next is that I don't know if you guys remember, we reported on it, but during COVID for almost 2 years, there was a lot of money flowing into banks, depository institutions, and but since 2022, summer of 22, the last few months, there has been an incline until this summer of the amount of money that's being deposited. Now, all of a sudden, less money from the paychecks that to set up these depositing accounts, fewer and fewer dollars are actually being deposited into these depository institutions. The interesting thing is it's scaring these banks because the certain amount of money is made from these deposits, which go towards reserves and go towards fractional reserve lending. And so these actions, some banks have been more successful in keeping the deposits because they're banks are going on defense. They're raising interest rates because the money in the overnight accounts can be used for bank investment purposes. And so we just wanted to put this on your radar that that less money is being deposited since the summer, and there is a striking downtrend of the amount of money that are available in deposits. So it's not a run on the bank. It is a stop depositing in the bank. So more on that as we learn, as we get updates. Now, our final section is basically lenders are facing uncertain legal risks amid PPP fraud investigations. So let's kind of do a little backstory here. The Paycheck Protection Program, which was announced very shortly after, like in April of COVID, April, May, after in 2020, what ended up happening was lenders were guaranteed repayment by banks, or by the feds. I mean, the lenders, the banks, were being promised that if the money that were being offered through the PPP program, if that met certain criteria, then the loans would be forgiven. Okay, but you had to use the money in a certain way. If it wasn't forgiven, it became a note. And if those notes were not paid, the federal government guaranteed the banks because they were the issuing institutions. Again, just like Fannie Mae, Freddie Mac are guaranteed by the loans, by the feds, FHA, VA, these loans are all guaranteed by the Fed or by the federal government. So when PPP distributions were occurring, they were basically saying yes to everybody. And there was a huge, come to find out, a huge number of persons who were literally lying about the types of companies they had or how long those companies had been open, and were filing for PPP loans and actually getting funded, and hoping to get them without having to pay them back. And a great deal of fraud was occurring. We're even familiar. One of our referral partners who sends us clients had a case of one of their clients is currently serving jail time for 18 months for PPP fraud. Thankfully, we are not part of. We didn't source in or anything. Fundability principles didn't even really matter to the PPP loans. They matter to the EIDL loans, but not to PPP. So the problem is now that we've got this fraud out there, the federal government is prosecuting fraud, but lenders who issued the loans are not necessarily going to be reimbursed for that money. So there's uncertainty in the legal risks of them issuing the money but not doing the due diligence required. So more on that soon, but there's going to be a huge brouhaha. For example, in September, Houston-based Prosperity Bank reached a settlement the federal prosecutors touted as the first of its kind with a PPP lender. It's an example of a rare example of a bank that lowered the due diligence standards to quickly approve PPP loans. So if the money was sent out, they're not guaranteeing them. And the federal government, at least in the case of Prosperity Bank has to reimburse the Fed for losses on the part of the Fed. So there you have it. The Fundability report. So much going on out there. It's a little light week, but every Tuesday at 3:45 Mountain Time, you can count on us to take you through what's going on in the borrowing industry, the lending industry, and especially fundability and the relationship between borrowers and lenders. This is Merrill Chandler, your host of the Fundability Report. We will see you next time.